Hi everyone. Often it happens that you like a stock and fundamentals of the company also attract you, but still you don't invest because you're not sure about performance of people who are managing the company. Because we as retail investors don't have visibility to the people who are managing the company. Example in case could be Tata Motors is a good brand and their EV potential is massive, but you might not be sure about the people who are managing the Tata Motors. Are they smart or are they going to sink the company? These questions we can't answer. So in today's video, we will understand a ratio called ROE and ROCE, and you can take a logical understanding of management's performance. So let's get started. Let me pose a question to you. How can you judge management's performance? Can you say a management is good if the board members have studied from IIT and Harvard? Or can you say management is good if promoters are doing good marketing and are true nationalists? Or should it be ROE? The answer is ROE. It doesn't matter what they have studied from. It doesn't matter what kind of marketing they are doing. It doesn't matter where are they aligned politically. All matters is that how are they performing and what is the return on equity. Now let's try to understand what is the meaning of return on equity. We will take an example of ITC to understand how can we calculate return on equity and what is its meaning. So ROE or return on equity can be defined as net profit divided by equity capital. Now what is equity capital? Equity capital is nothing but your share capital plus reserves. Let me take you to the screener.in and help you understand how you can calculate on your own. If you look at the balance sheet of ITC, you can see that in FY21, the share capital was 1,231 crores and the reserves are 59,116 crores. So if you add share capital and reserves, you get the equity capital. This is the money which is really available to the management and they can use it. And if you go to P&L statement, you can see that in March 2021 they made a net profit of 13,161 crores. If you plug these numbers in the formula, you would get 21.8% as return on equity for ITC. Now how can you read this number? So what ROE means here is that if you give 100 rupees to the management of ITC without any debt, then the ITC management can make it 124. That's how efficient the ITC management are. So greater the ROE, greater would be the prospect that management of company is good and vice versa. Of course, it also depends upon the kind of sector where the company is operating, but ROE gives a very good picture to understand the performance of management of a company because this proves that they are able to manage their own money very well. ROE gives you the picture when management does not take any debt or any kind of borrowings. But what if management takes lot of borrowings and you still want to know how they are able to manage those borrowings and how efficient are the management in utilizing those debt. So if you want to judge a company which takes lot of debt or borrowing, then you can use ROCE to understand the management's performance. So if someone asks you how can you judge a company which takes debt or borrowing, your answer should not be that by reading news every day and finding out. Your answer should be ROCE of the stock and not praying to the God that all is well and the management will take care of the borrowings. ROCE or return on capital employed can be defined as EBIT divided by total capital plus debt capital. What is EBIT? EBIT is your profit before interest and tax. Let's take the example of ITC again and try to see if we are able to calculate ROCE of ITC. If you look at the balance sheet of ITC, you can see the borrowing of 271 crores in FY March 2021. So this is the debt capital which the company has raised, and the equity capital as calculated previously is summation of reserves and share capital. If you go to P&L statement, you can see that in March 2021 the operating profit reported was 17,065 crores and this is your EBIT, which is earnings before interest and taxes. If you would have noticed, the major difference between calculating ROE and ROCE is that in ROE you use net profit and in ROCE you use operating profit. So for EBIT, we are going to consider operating income because that's what EBIT means. Once you plug this number, you get ROCE of ITC as 28%. Now, what does this 28% mean? What it simply means is that ITC management will make 128 rupees for every 100 rupees when they deploy their own money as well as borrowed money. So while calculating ROCE, you have to use both equity capital as well as debt capital. Debt capital is your borrowings or loans or anything which company raises through debt instruments. So essentially ROCE tells you how effective or efficient are the management in managing their debt and how effective are they in utilizing those funds to generate profit for the company. Now let's try to understand some critical difference between ROE and ROCE, and which you should definitely remember while analyzing ROE and ROCE of any company. Equity capital for sectors like IT, FMCG, digital business, etc. are less capital intensive, and hence the denominator here would be less. It would have higher ROE. So you would have seen that companies like HUL would have very high ROE because they are not very capital intensive. Similarly, in ROCE, if you have to understand equity capital plus debt capital, what it simply means is that capital intensive sectors like utilities, telecom, infrastructure require large debt and other liabilities, and hence their denominator will be very high, and hence they would have lower ROCE. So companies like Tata Power, Adani Power require huge amount of capital to buy coal, to buy machinery, etc., etc. And hence for them ROCE would be very low as compared to other sectors. So the message here is that you should choose similar companies while comparing ROE and ROCE. It should not be that you are comparing HUL with Tata Steel, because ROE and ROCE of steel company would be very different from ROE and ROCE of a FMCG company. Second point which you should always remember is that ROE considers net profit. What it simply means that ROE simply tries to calculate what is the profit after deploying the equity capital and no debt capital. Whereas in ROCE, it considers EBIT or operating income, simply because in denominator they are already considering debt and borrowings. So the message which I'm trying to give here is that ROCE is best tool to judge companies which take huge amount of loans and borrowings. But if a company is not taking any sort of loans or debt, then ROE is the preferred ratio. You can say that ROE looks at returns from the point of view of equity shareholders, whereas in ROCE it is best for stakeholders like lenders, debenture holders, bond holders, or the loan givers, etc. The message here is that even though debtors earn interest by lending, but still ROCE is very important for debtors to understand if the management is good enough to manage the borrowings and will they be able to utilize the debt efficiently. So often people question whether ROCE should be greater than ROE. The answer is that it should not necessarily be, simply because when ROCE is greater than ROE, it essentially implies that debt holders are earning higher returns than equity shareholders of the stock. So what it simply means that if you have 100 stocks of ITC and their ROCE is greater than ROE, then it is better to hold that bond of ITC instead of their shares. When ROCE is greater than ROE, it essentially means that debt holders are earning higher returns than equity shareholders. Because if you remember the formula, in ROE, it's equity capital, and in ROCE, it is equity capital as well as debt capital. So if ROCE is greater, then it means that debt holders are earning higher than equity holders, and hence it complicates the situation because it probably makes no sense for you to own the shares of the company. Instead, you should own the bonds of the company because ROCE is greater. Now if you are confused, so the final verdict is that basis Warren Buffett, you should look at ROE for zero debt company, and ROCE is best for debt ridden company or the companies who have taken any amount of debt. And what Warren Buffett prefers is that ROE and ROCE should be approximately equal. They should not vary a lot, and the figure should be above 20% for both ROE and ROCE, so that stock is beneficial for both equity shareholders as well as bond holders. Hope you like this video. Let me know if you have any question. Thank you.